If you also think that crowds transform real estate debt and the mortgage finance system, then you are in agreement with my guest today, Brew Johnson, founder and CEO of Peerstreet, the online marketplace for investing in first position debt. Welcome to the National Real Estate Forum podcast, episode 206. Thank you for joining me today. I am Dr. Adam Gower, and this is the Crowdfund project at nreforum.org, where developers, investors, and industry leaders share insights that you can use to raise capital and invest in crowd-funded real estate deals. I am getting a lot of feedback that tells me that the term crowdfund real estate is somewhat misunderstood. People react in three particular ways. There are those who have no idea what it is and so think of it as being a bit spammy. There are those who have some idea but who resist because they have the erroneous misconception that the fees are too high or something along those lines. And then there are those who have good familiarity with the space. These folk, especially sponsors, are totally sold. They have already crowdsourced equity for a deal, have had a good experience, and they want more. I like to think of the concept of crowdfunding real estate as being in a way nothing new. Buying stocks and shares in a company is basically just crowdfunding a company's ownership, and in a similar way, so is crowdfunding the equity or debt in a real estate deal. There are, of course, some significant differences, but the general principle of having part ownership through some kind of fractional share in an enterprise is much the same. I've written a primer. It's a PDF that explains in greater detail what crowdfunding real estate is and what it means to you, whether you want to raise money for your deal or invest in real estate. You can download it at the nationalrealestateforum.org website. Just go to nreforum.org/primer and I will send this to you absolutely free. My guest today is Brew Johnson, the visionary founder and CEO at Peerstreet, one of the only marketplaces to be investing in first-position loans. Brew is one of an insightful few who saw the inevitability of the 2007-2008 downturn before it happened, and who was able to insulate himself from the worst of the fallout. He has taken the lessons learned from having seen how badly the real estate market can fall from its heights, and has applied it to the business model at Peerstreet. Hearing Brew talk about his and the platform's background and philosophy will give you an excellent sense of who it is you are investing in when thinking about Peerstreet as a place for your investment dollars.
I was in law school from 98 to 2001, so during the dot-com boom. And, did my undergraduate degree at USC here in LA and then went to law school at UCLA across town. And, had planned, during the dot-com boom, obviously, like everything was tech. And, in law school I was planning on, getting into, when I graduated, the whole goal was, all right, let's do tech work in the tech industry. And so when I graduated from law school, I went to work for top 25 international law firm. It was the number 2 top 25 international law firm. It was the number 2 kind of largest tech-focused firm in the world, called Brogan, Flager, and Harrison. And, when I was in law school, I had my brother found a tech company, which was a user-generated content travel company, and kind of planned on doing tech work. And obviously from the arc from 98 to 2001 was very, the dot-com bubble had exploded kind of in 2001, obviously. So I got out of law school going into this great job with this firm that when I was in law school, I was working on IPOs and M&A and just all this exciting stuff. And I got out and things had blown up and cratered. So, the office that I was going into, there was something like 10 or 11 incoming lawyers were supposed to be coming in. They fired most of them except me and one or two others and said basically like, hey, the tech work had completely dried up. So but we have labor work or real estate. Our labor and real estate departments are busy, so where do you want to go? I said, real estate. And it was one of those kind of serendipitous kind of things, I think. It was the beginning of things. So I started practicing real estate law. Then I got recruited to go over to what is kind of generally regarded as the top real estate firm on the West Coast, a firm called Allen Matkins, which you may have come across over the years.
Sure.
So I ended up practicing kind of like by happenstance, really. I mean, to be totally frank, I kind of started practicing real estate law from 2001 through 2005. So I kind of came out of this .com bubble environment into this real estate market that was starting to go, crazy. And when you work at a firm like Allen Matkins, you just get exposure to every sort of real estate related client, from major banks to small banks to developers of all sizes. I mean, everybody from the small local developer to Toll Brothers and Centex and Lennar, and just a huge breadth of experience. And things were happening on the market just didn't intuitively make sense to me. I'd go out to our clients' projects and, or I'd touch somebody and I'd get qualified for a loan that felt like it was double the size.
Right. This was when exactly? This was what, 2005 and 6 or so?
I mean, to be honest, earlier than that, because the whole thing that was strange is that, my first firm, Brobeck, represented, the big client that was a master plan developer that was developing Ladera Ranch in Southern California, a huge master plan developer.
Yes, that's right.
Every week, you'd go back out of the project every week, and like prices were just going up as early as 2002, right. And like very early, like on this weekly basis. And the story was like, oh well, it's just because of affordability, because interest rates are low, people can afford more. And it's kind of like, okay, well that makes sense when interest rates are going down, and the reason interest rates are going down is because the Federal Reserve is driving these kind of prices down after this .com blow up. But like, okay, well what happens if that unwinds? So even very early on, at 2002, 2003, I just seemed like things like the whole bit was driven by this kind of monetary policy. Monetary policy always seemed strange to me. And it just seemed like, okay, well, this is not a sustainable kind of thing if that's the only thing that is driving this, because, obviously things revert to the mean, and there's probably like a point where rates are going to be going down and affordability isn't going to continue going up. And then so it started pretty early of kind of like, okay, well, that makes sense to a certain degree, but is this like a sustainable thing with like why that affordability is driving things? And then just as years went on, it just like, it went from that affordability thing and the interest rate thing to just like this excess liquidity. So it was like, a lot of things built on it, but at the end of the day, like what was happening in the market just didn't make sense intuitively to me, and I became obsessed with what was driving everything. So the kind of first signs were in 2002, 2003 of just saying like, okay, this thing isn't this affordability argument isn't complete. It's not forever. And then as things got later in the cycle, it was just like, I mean, it was just almost without doubt, like across the board, there was just stuff going on that was insane. I mean, clients were buying properties, for 5x what they trade, like industrial properties for 5x what they traded for a year before, because they're going to put up 10,000 condos in a city that had sold 1,000 condos over the previous decade, and there was 150,000 condos going in the next city. It was one of these things, and you hear people rationalizing things like, oh, they're not making any more, like Las Vegas is land constrained. It's like, well, no, it's not. If you've ever been to Vegas, there's no constraint on land, and like, all these kind of stories that just seem like these interesting justifying things. And then, you saw just kind of that classic behavior of people that I was friends with were buying properties just to sit and hold for 6 months to sell, like without doing anything.
Exactly, without no added value, exactly.
Yeah, and just like it's almost like you always hear the story of who it gets attributed to, like whether it's Bernard Baruch or Joseph Kennedy in like pre-crash in like the 1920s of the shoeshine boy giving him stock tips. It was like a similar environment. I mean, one time I was getting my hair cut at like a Supercuts, and the hairdresser was talking about
got advice. Right.
We're buying condos in Vegas, and that's a great way. If you get in early, you can make all this money. It was just like insane. So
yeah.
So I just became obsessed with it. I became obsessed with the securitization market, everything that was driving it, and it was just like such an obvious house of cards. I mean, in 2004, I convinced my fiance to sell our condo that she'd owned for two years in Brentwood and doubled in price, right? So like, I was too early on the side. I started shorting Fannie Mae and the banks because it was just, to me, it was like, it was based on this crazy leverage. I mean, you knew people that had 50 homes that were financed by 100% financing by banks, just, holding these things to like, just so they appreciate in value. Like, if you're getting 100% financing to buy a property, you don't own that property, you're renting that property, so you have no skin in the game. So if interest rates spike up a little bit pretty early on. So anyway.
Yeah. And well, you know what? I think this is probably amongst the most valuable experience anybody could have in this space, right? When we talk about crowdfunding and the Jobs Act and the way the industry is developing, just to pivot to the bigger picture briefly before you continue. One of the issues is that the Jobs Act was enacted in 2013, right? So nothing that has happened yet in the crowd-spacing real estate arena has seen a downturn in the cycle. It's only been uptick so far. So having the insight that you have in what happens when the market has a downturn, I think is absolutely critical. And as we get a little deeper into Peerstreet, there's actually something that I've seen you do that I'd love to talk to you about. But before we get, I've written it down so I won't forget it. Continue with how you got to Peerstreet and how you managed it. Continue with how you got to Peerstreet and how you managed to bring these two worlds together, tech and real estate.
So I'll, and I start, sometimes I start rambling about stuff I go on for hours, but I think it's important, like, that kind of perspective. And so when you're at that side, and like, for me, like, on that side of the table of like identifying this stuff early and it being 100% certainty that it was like a house of cards, and just, my brother would always comment that I was the worst cocktail party host because everybody was talking about how much money they made on these condos in Vegas, and I was just telling everybody that the world would end constantly. But it's like it was one of these really frustrating things. It was also really frustrating because it's like the fallout effect of it was going to be so massively negative to so many people, right? It was like really it was this frustrating thing, and like, to me, it was just like the system, the base of the kind of the mortgage finance system seemed broken to me, and not get up to too. I'll try to cut this off, but it's like, it's really instructive of how we, and the other part that was frustrating me is like, I knew this was coming, and I'd go into like my 401k account or my wife's 401k account, and the safest option that you could choose of like the safest option was like a U.S. government bond fund. Like, there was one that was classic back in like 2000, and my wife worked for a major pharmaceutical company, limited choices of what you could invest in. So the safe option was the Goldman Sachs, something like the U.S. government bond fund. And if you went into that thing, it was about 1% or 2% treasuries, and the rest were these like CDOs and all these like crazy leverage vehicles that were nuts. So it was like this whole idea of like this like securitization finance machine driving this thing and just putting the average person at risk. So it was just an incredibly frustrating thing with me. So by the end of 2005, it was like I had this idea that, okay, the world is definitely going to end. I don't know if it's going to end next year or in 3 years, but it's like it's a 100% certainty it's going to happen in the kind of financial market. And so I was planning on doing it's a 100% certainty it's going to happen in the kind of financial market. And so I was planning on doing like a type, waiting for the things to fall out and doing some sort of like real estate vulture fund or something. But my brother had this tech company that I helped him found when I was in law school, and it was growing, and he needed help. So I went to work for him as his general counsel and director of business development. And that was like the beginning of 2006. And, helped build that business. But you know as well as anybody that like the cracks in the system were happening in 2006 and 2007. And Lehman was kind of like the final straw, but it's like it started happening much earlier than that, and people were kind of deluded to the fact that it wasn't happening. And so I basically convinced my brother to sell his company because I was like, look, this is bad things are happening. But the key piece here is, I think, coming out of like the real estate world, like which you identified as like so just it's antiquated. Real estate world, like which you identified as like so just it's antiquated and old school for a reason, because it's like this physical market where things are very unique, and like you need to know. So there's a reason why it hasn't been transformed by technology yet. It's like kind of last major asset class to do it. But then going into the day-to-day operations of a tech company and seeing the power of it, I at that point I thought, wow, when the banking sector or a huge portion of the banking sector goes away, there's going to be a need to fill the void. And I saw what companies like Lending Club and Prosper were doing in consumer credit, and I thought, wow, if we could do something like this in real estate, it could be incredibly powerful. So I actually kind of started incubating this idea in 2008. I actually worked up a business plan, but it wasn't the right time for a lot of reasons. A lot of it had to do with the legal and regulatory environment.
Right.
But I put the idea on hold. We ended up selling my brother's company to TripAdvisor, which at the time was wholly owned by Expedia. Stayed on there for a while. But during the crisis, did a lot of things, bought for, and had this really interesting experience. So now fast forward to 2013. A lot of things had changed in the market that made this business that I was like very passionate about, going back 4 or 5 years, very, very a lot more viable. Right. One is the Jobs Act, and I think the passage of the Jobs Act itself was kind of like, okay, this is big. But when the FCC promulgated their original rules of how they would like enact it, it was like, okay, now is a good time to do this business. But in addition to that, like Lending Club had hit critical mass in the consumer credit space. Things that were going on in Europe in terms of with crowdfunding and peer-to-peer lending or marketplace lending, the market acceptance of it had kind of hit that. And so at that point, it was like, okay, I had a bunch of different real estate stuff I was working on. I put everything on hold, and then I reached out to my co-founder, Brett Crosby. I raised some money for the idea, and then we started building the business. And so that's kind of the background of it. And the reason I kind of go long on it, that long kind of background of the real estate, the legal, this kind of securitization, this knowledge of how at least big picture of how that system works, and then the kind of tech aspect of things and how to create like a scalable tech platform. We've kind of pieced them together in a way that we think is very, very unique and different than anybody else who's out there doing any sort of like, whether crowdfunding or marketplace lending in real estate. And, at the end of the day, sorry, I'll pause there for a second.
Well, I was just going to say, yes, so tell me, in what way is it unique? Why is it unique? And you picked a particular asset class to pursue. So tell me about the asset class that you're looking at and why you like it in particular, Brew, in the context of your experience having seen a major downturn.
Yeah, that's a great question. So just in general, I am a firm believer that, transacting through an online platform and the idea of crowdfunding and allowing people to access investments, but access it, in smaller amounts, more transparently, I think it's just, to me, it's clearly the way the future goes. So as you're looking at types of assets to invest in, and obviously real estate investing, which you know as well as anybody, there is a million flavors to real estate investing, right? From equity investing to preferred equity to mezz debt to, all sorts of things. And so if you look at it from the outside, it's like, okay, where is the most appropriate place to do a real estate investment online, right? And so if you're looking at, and then the second piece is like, okay, if you're going to be exposing investors around the world and creating like a platform, there's things you want. You want to kind of grow a large online platform. It's just imperative that you establish credibility, right? And it's imperative that you do your best to establish some level of safety or security for investors, right? And then you need something that can scale, because like if you're not going to be scaling to large numbers, a technology platform doesn't really work, and it doesn't provide that much value to the users, the participants, right? And so, and I guess one example to look at there is like, in back in like the .com days, it would be the difference of like, the idea of like the scale is important. It's like eBay or Amazon versus somebody that has a shop and puts up a website where they can sell their goods on, right? There is power in that scale, because scale creates network effects. So it's like, okay, so kind of this idea of like, okay, scale is important, credibility and safety for investors and credibility for that platform to kind of help loop into that scale is all important. What asset class is the most appropriate to do this? And to me, and the other fact on my side and mine and Brett and our co-founder team side is like, we think the long-term ramifications of a platform like that leverages like a marketplace, we're more in the marketplace lending or in marketplace for investing in real estate. We actually think the long-term ramifications of it are very, very massive. It could potentially transform that securitization market I was talking about. So for us, it was like, okay, the most appropriate asset for most investors to invest in is real estate debt, and specifically first position lien debt. And the reasons are obviously simple. It's the safest part of the capital stack, right? It cash flows, so it like throws off cash for people. And it's also just a lot more consistent in terms of like the idea of like, if you're doing an equity investment in real estate, that's an independent kind of deal that almost every single deal is unique, and there's not that much consistency. So the idea of being able to create a scalable platform that provides value for both investors, let's start with investors, you need that consistency, you need that homogenization, and really you need something that, in our opinion, where, put them in a safer position than other options out there. So we specifically from day one, we're saying we're going to focus on first position lien debt because it's safer than other type of real estate investments. We think it's more appropriate. And also it's like, in the event that there is a downturn and you're kind of trying to create a new industry or new asset class with this investing online, in the event of a downturn, that end investor is much, much more protected. So anyways, that's part of what dictates is the idea of like, all right, there's always risk in investing, but if you're going to be opening up a platform to kind of the masses and investors, you want to position it from a place that puts them in the most consistent and of the options out there, the safer part of the capital stack is the way we do it.
Okay, so I think that you have a very interesting metric. Your capital is who invest in local people, local developers who are doing single-family home primarily, single-family home loans for fix and flip typically. You have a minimum loan-to-value threshold, so that's fairly standard. But you also, very interestingly, you also have a metric that looks at that particular location's decline relative to its peak over a 20-year period, right? To measure what your maximum leverage is going to be. Can you explain that to me? Because that's an interesting thing, how you came up with it and why you think it's important.
Sure. So obviously, like the number one risk factor in a real estate loan and collateral loans is the loan to value, right? The loan to value ratio. So the idea is like, okay, that's the starting point. But I think the idea, so when we look at risk of in a loan in terms of that particular idea is like, okay, that's the starting point. But I think the idea, so when we look at risk of in a loan in terms of that particular metric, the idea is, okay, well, what are the typical risk factors of a loan? Like what is the LTV? Who is the borrower? Those metrics. But the idea of that kind of looking at data to make informed decisions or investors to make informed decisions, I think is like a part where it hasn't been available for before. So, in our opinion, if you're looking at kind of historic cycles of the real estate market, it's like, yeah, you could have a great LTV, but if you're in a market that is declining or potentially has a huge amount of overhead or a huge amount of inventory, your risk factor is a lot larger because if things slow down, prices would drop or there's a potential for liquidity. So the idea of like trying to analyze what is the health of a submarket where a property is located kind of currently and what we think kind of is this the type of market that during the financial crisis dropped 5% or is it the type of market that dropped 50%? And so I think the idea there is just allowing investors to make a determination or be able to surface that information where investors can look at it and make informed decisions on it. So for us, it's kind of like when I look at investments, I'm kind of like one of these cynical sky is falling people. I always start from like, okay, what's my worst case scenario on this on this particular investment? And so that's really the idea there. And look at the classic thing that history doesn't repeat itself kind of thing, but it may rhyme, that whole rhyme thing. It's like, yeah, we have this recency effect of what happened in 2008. Could there be another financial crisis? Absolutely. Could there not be another financial crisis for another 20 or 30 years? Yeah, that's possible too. But I think the idea is being able to at least form a decision and allowing people to look at information and say, okay, here's this loan. The market that it's in is currently trending up. And, oh, by the way, crunching a lot of data and statistics, it looks like it's forecast to continue going up. But if for some reason that's wrong and the market turns, here's what a potential downside scenario is. I think is important. Now, so I think that's important, looking on a loan-by-loan basis and investing on a loan-by-loan basis. But I think the most important part and why crowdfunding is crowdfunding or what, marketplace investing or marketplace lending, whatever term, they're all kind of related to each other. But the real innovation in that is the ability to allow investors, instead of investing in one loan at a time or one investment at a time and putting a large amount of money in a concentrated position, is be able to look at that loan, analyze the risk for them or whatever what the risk is, but then spread their risk across a broad pool of loans to be able to minimize risk through diversification. And I think the combination of looking at data smartly and looking at data correctly, but then also the ability to just diversify very, very broadly is just a fundamentally different. Also the ability to just diversify very, very broadly is just a fundamentally different way to invest in real estate. In real estate a little bit, but particularly in real estate debt. There's never been a vehicle like that. And so the idea of being able to kind of create these, let's analyze data, let's be very transparent with it so investors can look at it and get their idea of what they think the risk is. But then the last piece of it is allowing investors to get broad diversification. We think that combination is just very powerful.
There is a summary of today's episode as well as a downloadable transcript in the show notes at nreforum.org/Peerstreet. Right, so in your case, the broad diversification is instead of putting, for argument's sake, 100,000 into one loan with one guy on one house in one town, you could put 10,000 that is across a range of locations.
That's right. And so, I skipped over a little bit the asset class, but the hard money lending is the asset class. Tell me about that, because that's also that's something unique to Peerstreet, as far as I can tell, at least so far. Yeah, look, there's other players playing in it, but the way we've attacked it, that you identified as like partnering or working with these offline hard money lenders is a very unique thing. So, but the asset class generally, so the focus of the asset class is short-term bridge loans on single-family property. So the fix and flip and kind of short-term bridge or short-term buy-to-rent type loans is the focus. And so, you nailed it. Historically, it's been called hard money lending. It kind of had a negative connotation historically in certain areas because historically, the kind of use case is like either a real estate investor or entrepreneur has a property or finds a deal that they want to do. They need to move quickly on the deal. So they need capital fast. So they would historically go to a local hard money lender, pay a very high interest rate to get a short-term loan to go buy and take down a property, and then potentially sell it or refinance it later, to take out a short-term high interest rate loan. It's this really interesting kind of shadow part of the market and this niche part of the market that's always existed and been there, and it's actually been very important. But historically, it's like an incredibly localized business, and borrowers that borrowed there were very local. The lenders that operated there was very local. Borrowers typically only had one or two kind of places to go to kind of source this type of short-term capital. And then most investors, it was this kind of lucrative asset class. It was almost like this country club thing where certain lenders would make these loans with their own capital or have like a small network of friends and family, that they raise capital from to lend in. And so it's this really highly fragmented, localized market, but incredible risk-adjusted returns. If you look at historically hard money lending could range from anywhere from 10 to 20, 25% annual interest rates on a secured loan that's collateralized by real estate. And so there's really interesting niche market. And so
Brew, let me ask you, how did this niche market perform during the downturn?
Yeah, great question. So it really depends on who the lender was and who the originator was. And so this is like a key thing. And like my love of this asset class, like my best friend's dad growing up, had a ton of property in our hometown, single family rental properties. He made a bunch of these hard money loans or trust deed investments in, some people call them in California. And, over a 30-year period, he never took a loss on a property. In areas that he owned property and understood the value of these properties and where he'd be comfortable owning that property. Right. And then when I became a real estate attorney, I was doing these deals of like people making these loans at 3% interest or 4% interest on a commercial property or something. I said, wow, there's another thing out there where people are making 15% return. And I know for a fact that these guys that have never taken a loss on these properties, this is just an amazing risk-adjusted returns, this amazing asset class, right? During the crisis, guys like my buddy's dad or the experienced lenders who lent in their areas and knew it very well and put their own money at risk and knew that, they performed okay and they did well. Like a classic example is one of the largest hard money lenders in the country is Anchor Loans in LA. They've been lending for a long, long time, very experienced. Through the downturn, their investors, I think their yields to their fund and their investors went down to like 1% or something during the crisis. And I think as a fund, they might have cut their management fees, but their investors didn't take a loss during the crisis. Now, other people who were chasing the market lost everything because they were making risky loans and they weren't structuring their loans correctly and they were over advancing and giving too much capital. So I think the idea here, I think the key thing is like, look at people who know what they're doing and have expertise and track records and understand their markets they're lending in and their borrowers. I think can fare well in almost in a variety of different markets. And so in terms of kind of like a regular functioning market, I think it's a good asset. And then there's this other kind of interesting that in downturns, lenders that know what they're doing and can lend in downturns actually have an advantage. It's counter-cyclical because downturns, source of capital dry up. So actually, like, advance rates can decrease and interest rates can go up. But really, who makes that loan, in my opinion? That's something that, like, is structured. So when you asked earlier that we've structured things a little differently, is there's a lot of people out there in crowdfunding or marketplace lending that are going and wanting to do the deal or investment directly or make a loan directly to a borrower. In our opinion, we don't want to be in the lending business, and we don't want to do that because in this asset class, it's such a localized business. We would rather rely on those lenders that have track record and experience to go be the first layer, to go make a loan, to go underwrite a loan, to go service a borrower. And so that's what our idea here was like, okay, let's create this tech platform that connects those local lenders to the capital markets and to investors. And by doing that and being this kind of intermediary between those, you create value for all parties. So, I mean, and the analogy here is really what we're trying to do is take all the positives from the securitization market that exists in regular lending, broad diversification, cash flow, all that stuff, but apply it to this more lucrative, kind of historically very fragmented market, but then learn from all the issues that created the financial crisis, leverage, and allow investors to invest in this asset class, access it, be able to diversify, invest in a way they've never been able to do before by investing small amounts across a lot of loans as opposed to putting a lot of eggs in one basket.
Right.
And then making it hassle-free and very, very transparent. So that's the whole idea. So we try to the idea is like, okay, well, we create a secondary market for these lenders out there. We can provide them capital for their business to go make loans to more borrowers. And then all at the same time, providing this access to these investors. We look at it as like a much better aspect. And so in our opinion, that's the proper way for a crowdfunding platform or a market aspect. And so in our opinion, that's the proper way for a crowdfunding platform or a marketplace like us to investors, not to be the one out making the loans, is to be the gatekeeper intermediary between those, or the connective tissue between those groups, the investor and and the experts. And I actually think this kind of similar model, while we think it's more appropriate in debt, because we think debt, the consistency and you can apply technology a lot more consistently to debt, I think the same concept applies to equity investing in real estate and crowdfunding. And so I think the idea there is look at the experts of real estate are experts. They know their markets, they do that. A new entrant that comes in to try to compete with existing experts doesn't make as much sense to us as opposed to being this intermediary that aggregates up high-quality supply, curates it, and then homogenizes it for investors. We think that's the proper way to attack it. And so that's a fundamental difference of how we're sides of the marketplace and reduces adverse selection and risk for investors and things like that.
So the due diligence that you conduct actually is two-layered. One, you do due diligence on the lender. Presumably that's your primary due diligence. You look at their background, their experience, their track record. And then you also screen out their deals and presumably also cherry pick might be the wrong word, but you pick the ones that fit your own risk profile, right? That conform with your 20-year downturn risk-adjusted investment strategy.
Yeah, that's right. That's right. Yeah, and cherry picking is, cherry picking, I used to kind of talk, yeah, that's right. That's the curation aspect of it. I guess not cherry picking as much as the goal is to surface as many high quality assets in the highest quality amount, right?
Right.
But so the idea is we have our amount, right?
Right.
But so the idea is we have our underwriting kind of overlay that we lay on top of these lenders.
On top of their overlay, right? So they have their own underwriting standards.
Yeah.
And then you apply another layer on top of that, and whatever screens through from theirs that meets yours as well goes into your pool.
Yeah, that's right. And so and look at a loan that you would look at on a loan by loan basis, so our goal with this is look at that local lender, that lender, the one who's making that original, you're probably exactly right. We first underwrite them. That's the first step that is very, very key, and get comfortable with that sponsor effectively, right? And their track record and their licensing and their legal and all of that. So once they onboard them, then they bring us these loans. And so the idea is so you have, in our opinion, you've got the value of that local, ideally local kind of expert with track record, and then we have this overlay. Now, our overlay tends to be a little more conservative than if, our underwriting guidelines, like our maximum LTV is generally a little below what the overall market out there is for these loans. And look, at the end of the day, some local lender, we have a max loan to value of 75%, right, currently. A lot of markets, people lend more. And in certain cases, and as we've grown and developed more data in terms of what we think of our high performing borrowers and loans and markets, we'll adjust that LTV standard up in certain cases, right? If it meets a fact pattern or data set that seems to allow that. And then if investors hypothetically want more risk, they can potentially take that. But at the end of the day, the person who's if one of our local lenders wants to make a loan at a 90% or 95 or even 100% LTV to their best that sort of risk, because they know their market really well. But for the average investor who's investing in these assets that's probably not the appropriate type of risk, right? So what's interesting about the platform we set up is we can kind of have the best of all worlds, where those local lenders can still take that risk level, and we can still allow investors to invest at an LTV level that we're comfortable for. The idea is try to just surface those what we think are higher quality assets and a higher amount. And this is that combination that we think is powerful. But I think over time, the more data you collect by analyzing what people are doing and which lenders have great track records and which are, you can then adjust the underwriting criteria to do that, but it should be data driven. And I think this is one thing that most people don't quite understand of how important the originator is or that sponsor is in deals. I mean, if you go back to the financial crisis, if you looked at, most people don't quite understand of how important the originator is or that sponsor is in deals. I mean, if you go back to the financial crisis, if you looked at loans were originated by Wells Fargo, IndyMac, Washington Mutual, they may have been securitized and had a very similar rating on top of them, or looked very similar from a third party's view. But after the crisis, the default rates on those loans were significantly different, right? Wells Fargo outperformed those guys by a pretty significant degree. So there is this importance of that, who is actually that first kind of touch on the loan. And the idea is investors probably want not only just more diversity across loans, but also diversity across the originator or the lenders who originate those, because, that potentially reduces risk.
So where do you see the future for Peerstreet and for this industry altogether, right? The real estate and what you might call crowdfunding or syndicated finance in the way that regulations have allowed. I mean, we're right at the beginning of this new industry. Where do you think it's headed, Brew?
I think it's important to kind of bifurcate out, debt from equity as a starting point. And so, let's focus on we'll talk Peerstreet just because I live and breathe it every day. But right. Yeah, we think technology. I mean, our whole thesis, and I truly believe it, that technology is going to completely transform real estate debt and the mortgage finance system. And if you ask what our long-term vision for this business is, we think Peerstreet can disrupt the entire mortgage securitization market, the finance market. Because really, that's what we look at it okay, if you can connect investors more directly to loans more efficiently, so they get better yields and have a better product by having more transparency and the ability to do,
hard money loans, aren't you?
Yeah, I think in the
that's a very big picture. That means that I want to go out and buy a house, and instead of going to the bank for my 4% loan, I might come to somebody like Peerstreet, who is able to offer a competitive product, but instead of lending to me through deposits, it's actually financed through your network of investors. Is that what you're talking about?
Yeah, that's absolutely correct. I mean, and the reason why I think that's the future, and this is one of these big picture things that I think some people when I talk about this, they look at me like I'm crazy or an alien. But if you think about the big picture, I mean, most people don't understand that almost everybody has exposure to mortgages and real estate debt, right? Traditional type mortgage debt, right? I mean, and the way the current system works is like a bank or somebody will make a loan, and if a bank is making a loan, they're using depositors' capital and they're applying leverage to it and they're making a loan for it, right? Traditional type mortgage debt, right? I mean, and the way the current system works is like a bank or somebody will make a loan, and if a bank is making a loan, they're using depositors' capital and they're applying leverage to it and they're making a loan for it, and they make revenue off that and they pay nothing to the depositor for it. Then that same bank sells that loan to Fannie Mae or Freddie Mac. And then Freddie Mac brings in, spends a lot of money and costs and creates bonds from that. And they sell it off to financial institutions. And then they create these mortgage-backed securities, right, these bonds from those. And then that bond and that mortgage-backed security makes its way down to things like the PIMCO Total Return Fund, which is almost, last time I checked, which is probably 9 or 12 months ago, was 47% mortgage-related assets, right? So every pension fund and bond fund is filled with mortgages, right? But by the time the interest payment from a borrower goes from that front end, and then subsidizing all these like intermediaries on Wall Street and these other kind of financial firms and managers, while it makes its way down to their retirement account. It's kind of perverse if you think about it from that. So and for me, going back to 2007, I would much rather have my money distributed across mortgages that I directly or almost directly own versus having my money in a bank, because banks were highly leveraged and could go out of business. So in the future, I could see I think in the future, instead of having money actually sitting in deposit, people can have money distributed across these loans and actually be earning the interest rate off of it versus that interest rate being able to go and distribute it out to these intermediaries. So that's kind of like the long-term vision of a business like this. And, we personally don't see that there's any reason why we think that can happen. Now, whether somebody comes to Peerstreet directly or comes to some lender, I don't know if it really matters directly. I think that what matters more is that investment demand from investors on one side of the marketplace. You can fund loans either through other lenders or directly, but you can fund it way more efficiently because you're not leveraged up. You're not putting depositors' money at risk, and so there's less regulation for it. But then I think the other piece that's interesting is that you could hypothetically price risk on a loan-by-loan basis much more accurately. And I think that's why crowdfunding and marketplace lending, however you want to describe it, has such a potential profound effect. And just one little anecdote here, not to ramble. I mean, if you and I go into a bank to get a loan through the regular mortgage system, and you go put 50% down, and I put 20% down, if we go through the regular channel, our interest rates are going to look very, very similar. Now, my guess is with your background and your history and everything, you're probably a phenomenal credit, right? And if you're putting 50% down, you should be getting a much lower interest rate than I am by putting this with your background and your history and everything. You're probably a phenomenal credit, right? And if you're putting 50% down, you should be getting a much lower interest rate than I am by putting 20% down. But it doesn't work that way because of the averages that it's based on. Now, the irony is there's investment demand from investors for that really super, your type of level of credit, and it's at a lower rate than the 4% that's out in the market. So you can actually get to the system, I believe, where you're not only are you giving better yields to investors or better rates to borrowers, you can create a system where loans are funded really, really quickly without having to go through this long, onerous process. But then more importantly, priced accurately. So if you're going to get a loan, say, hey, here's the interest rate you should pay if you put 10, 20, 30, 40, 50% down to buy your property, and that interest rate should accurately reflect the risk profile of your particular loan. So that's where we think the future goes. I think every type of investors and borrowers.
Well, it'll be interesting to see how the industry evolves. Let me ask you a quick question, actually, that I've been thinking of as you've been talking. When you buy a loan and provide a secondary market to these lenders in local markets, do you buy the loan with your own funds or investors' funds and then backfill with crowdfunded money, or do you only fund if you're able to fund it on the platform?
We buy the loan and then we sell it off.
And then you backfill. Okay.
Yeah. I mean, I think the goal in the future would be to not. I mean, that's more of a function of kind of operate. I mean, in the current environment. I think over time, I think that probably goes away and you just match things directly. But yeah, currently we buy it. So we have a period where we effectively are balance sheeting those.
You own it, yeah. So the reason I asked that was because it sounds like when you start to scale up and do low credit risk market rate loans, that you could almost create a fund. I don't know if you can do this under the Jobs Act, but where you create a fund, maybe it's a Reg A type of scenario. Actually, it might be Reg A plus, where you create a fund that that sits there waiting for borrowers to come along, and as long as it meets underwriting, you can fund with that.
Yeah. That's funny. We've had conversations internally for that because it's an interesting thing. It's like short-term duration. There's potential for like liquidity for and some investors have asked are interested in that sort of thing. So there's definitely a potential to do that sort of thing as well. Yeah.
But on the same side though, you also need a secondary market for your loans, right? Because if you're putting out money to market rate loans, on a 30-year basis, that's a long time to be sitting on debt, even if it only has a 5 or 6 year predicted life. Yeah. Nevertheless, it's a long time on low interest debt.
Yeah, you're absolutely right. So actually, that's one of the reasons. So that's kind of like the last piece to like the ability to move into those longer dated assets, like the traditional mortgages, right? 30-year mortgages, like that. There's the liquidity issue is like massive there, right? Like being potentially locked up for that time period. So that's there's clearly not a place to start. There's a place to work towards in the future.
Yeah, well, that's what we're talking about, exactly.
Yeah, but I mean, look at. So I think so to me, like the liquidity aspect of it's kind of like a future piece to solve. And so there's either like the kind of idea on that is either I think in the future the reality is there's like some sort of like a platform like ours from the investor side looks more like a vehicle for investors to be able to like I think that's where the future of things happen. Potentially not, but I think the other thing is like there could be capital markets takeout like an institutional.
Well, exactly. Yeah. You could securitization if your pool's big enough, you can go that kind of route as well.
Yeah, and so I think the reality is I mean like practically, like the reality is there's probably like the securitization market or capital markets takeout, and then in the future some sort of liquidity thing gets involved or gets involved. But like I think one thing actually I should probably highlight, like the idea on the crowdfunding. I think a lot of people think like, okay, this is just a bunch of like mom and pops or like small investors are investing in this, but the reality is like we have major institutions that invest alongside in individual investors. We have institutional takeouts from, mortgage REITs, hedge funds. So the idea to this is like the long-term goal is clearly to give individual investors, we have institutional takeouts from, mortgage REITs, hedge funds. So the idea to this is like the long-term goal is clearly to give like any investors more direct access and allow them to do that. But, I think the piece that's interesting is that this is the type of asset that institutions as well as love and are actually like the most sophisticated institutions in the world are investing right alongside individuals. And that's like an interesting thing that it's like, well, we have this like idea of like, oh, why have money in bank accounts you got across loans? But the reality is like, it's a long-term time before you get there. And a lot of investors would actually rather have an institution invest their money, at least like right now. So, we have and one of the names, one of the reasons we named it Peerstreet was the idea of like, individuals could be peer with Goldman Sachs, like the most sophisticated, and access the same investments as the most sophisticated institutions of the world. Like that everybody should have access to the same type of investments. And so that's
very interesting.
Leveling the playing field between Main Street and Wall Street, that's really been kind of like an ethos for us. And like we think having institutions are important because institutions will help scale. Scale's an important thing for all investors because it means more loans, it means more data, it means more diversification. And so the idea is kind of like allowing those investors to invest side by side, we think is important.
Brew, thank you so very much indeed for your time today.
Yeah.
You are an absolute wealth of information.
Well, look, I'm sorry if I think you probably tell that I'm like very passionate about this. I think this is definitely the future of investing. And I think it's the future of real estate. I think why it's so powerful is that I think it provides better investments for investors, but also provides better and more efficient capital to borrowers, to real estate sponsors.
Returns in any individual location, and to add that metric to their underwriting criteria. Real estate crowdfunding has only existed so far during an upcycle in real estate. So returns, performance, and resilience are all so far founded only during boom times. There will be a recession in the industry, and when there is, there will be losses and failures. That Peerstreet are addressing this inevitability today is reassuring and worth taking a closer look at if you are thinking of making an investment through the platform. If you would like to read a transcript of today's episode and see some links mentioned in the show, please go to the nationalrealestateforum.org website to nreforum.org/Peerstreet. At the bottom of that page is the transcript that you can download or read on screen. In the next forum episode, my guest is Mark Roderick, crowdfund attorney. Be sure not to miss that by going to the website nreforum.org and subscribing on whatever platform you use to listen to podcasts. There are links to all the major podcast subscription services near the bottom of the nreforum.org homepage. And if your preferred platform is not there by any chance, let me know and I'll include it right away. Thanks again for tuning in today, and thank you also to Brew Johnson